Hey everybody, it's Pete Carmesino here at Chaikin Analytics. This is the halftime show on Stockcharts TV. On a weekly basis, we kind of look at things happening here in the market. And look, last couple of days here, we've seen a pretty volatile market, especially yesterday. We got down to that 2% level on the sell-off for the S&P. The Nasdaq was down more than 2%, and then everything kind of rebounded there at the end of the day. So here's what I'm saying. We got a little toppy here. We saw some indications of that with the bullish percent that I follow a lot. And we saw some situations there in the fixed income market where bonds started to retreat, which pushed rates higher. And why? Well, because inflation ain't going away yet. CPI came in hotter than expected. And inflation, we know, can be very sticky in certain situations. And we're already seeing some reports from, along different business models and different surveys out there of business owners. They're continuing to raise prices. Why? Well, because product prices are moving higher, wages are moving higher. There's a lot of push on the upside for everything that businesses need to deliver a product. And so they have to pass it on to consumers. Now, consumers are making more money in certain respects, some in other areas they're not. But my point is that you just saw it with UPS. They had a big Teamsters union fight about getting more, paid more for a salary for the drivers, about $170,000 or so. You saw that materialize in the third and fourth quarter. And then what UPS just announced a few weeks ago, they're laying off 12,000 people. That's what happens. You have to start paying people more. You're going to hire less or need less employees. And so eventually that should leak into the unemployment rate, which I talk about a lot. And I think that is the catalyst for lower rates. It just isn't there yet. CPI pushing higher. People are even talking about a rate hike potentially, sort of drawing that into the dot plot somewhere if this inflation stays persistent and continues to move higher. So again, there's a lot of ifs here. It's certainly data dependent, but at the very least, we got to follow the market trends, look at bullish percent, which I'm going to look at today. We'll look at a few sectors. One of the ones that are troubling to me is the banking sector. The regional banking ETF we'll review is KRE. We're going to look at a few charts today and just take a look at what's going on. Okay, we'll start here with the bullish percent on the S&P 500. Now I got a couple here. I'm going to go to this one that has the RSI on it. This is pushing down below that 70 level. Now for a while, right? Look at here between December all the way to the middle of January. You saw this push above the 70% level and then migrate lower, and really has done that consistently for most of the last 30 days or less 20 some odd trading days. I have an RSI, right? So RSI is an indicator. So is the bullish percent. So I have an indicator on top of an indicator with a moving average. Not very orthodox. I mean, a lot of folks can do this, and you can do this on the ACP platform. What I'm looking at here, though, we're trying to find the trend, right? What I do know is that the downside could be pressed lower, right, and stay low for a while on the RSI. Again, sort of the momentum of this particular bullish percent index, which is really a point and figure technical indicator, which basically talks about the number of buy signals on the point and figure chart for this particular index. So when you see it well below 30, it's a buying opportunity. And where was that? Right at the market low of in October. We talked about the Fed pausing and potentially cutting rates, and the market shot up and over anticipated. Now you're seeing the opposite happen, where rates may not be cut. We talked about this many times because the unemployment level, I think, has to move higher before they even think about cutting rates, because right now the economy is looking great. Back to the bullish percent, this is pushing lower, and I think could get to this average or even below, maybe to that 50% area, which it does quite often. You see it sell off, it doesn't quite always go back down to 30 and then pushes higher. But I think we got to watch out for that. The Nasdaq's showing me the same thing. No different, really. We had the oversold situation at the end of October. RSI is pushing lower. You can see that I have these different trend models I've been looking at for over the years. But the point being that overbought scenarios happen all the time. It's finally getting below the 70 level. Could correct it all the way back down to this 50. You could see that if you just look back in history. There's 2022. Here, what are we talking about? Again, 2023 in April, right around that 45 to 50 level. It could pause a little bit and maybe continue higher. But I'm telling you, that's going to be based on rates and what's going on here in the market. And the Federal Reserve is data dependent. So are we as investors and traders. So we've got to follow the data that we see here. Okay, so let's look at sort of the Fang index. We know this as those big mega cap names. They've been doing great. I mean, there's no doubt. They've been pushing higher. Now, not all of them have, There's two that are falling out of that magnificent 7 area. And I think they're becoming the fantastic 5, but you didn't hear that yet. But I don't know exactly what's happening with Apple or Tesla. Both of them are underperforming, while the rest of them, the Googles, the Amazons, the Metas, the Microsofts, the Nvidias for sure, are all doing great. But in this Fang index, pushing into new high territory here, even though we had a terrible sell-off just yesterday. Now, this is a weekly chart. If I go to a daily real quick, there's your sell-off. It just looks like a blip on the screen. Doesn't even look like it mattered, right? So again, for longer term perspective, this still looks like it's in an uptrend, but something we want to pay attention to. Now, I want to look at KRE, and I want to look at KRE versus the banking sector, but let's just look at the actual individual chart itself versus the S&P. On this particular ratio, you see here, this was last year's problematic situation with banks, right? Back in March of 2023, had a big sell-off, pushed everything lower. Now they started to move higher. Again, for the life of me, I'm not exactly sure what people are seeing here, because we know this in the market. It's not a secret that regional banks have the highest exposure to commercial real estate than the larger banks. Actually, there's I believe it's from the New York Fed, about 70% of all commercial loans are held on the regional banking level, or at the regional banking level. So you're going to see mark-to-markets change and things of that nature, especially with rates moving higher. You might start to see more New York community bank situations. Again, it didn't get too out of control, but the stock was down, tremendously in a few days and hasn't really rebounded since. So that's KRE versus the SPY, which means that it's obviously underperforming the market. But let's look at it against the entire banking index, right? So the regional banking index, versus the ETF. So I've got KRE as a ratio to the KBW banking index. Now I got a long-term chart here. This goes all the way back to 2006. The ratio has been in an upward trend. There's no doubt. That meant that the ETF was outperforming the index itself. It peaked here, rolled over, and took many years to sort of reconstruct itself into an upward trend. Now we're seeing, and I'm not calling this a head and shoulders, I kind of drew it on the chart because it just made sense. But if I'm looking at what's happening here in this chart, the target's down here. How do I get the target? I don't know. Average the neckline from this level to this level, inverse that, and it gets down to about that 30 level, which brings it back to, unfortunately, the great financial crisis. I don't know if that's going to happen, but if it breaks this trend line, it's on its way to this level, and that's not going to be good for regional banks at all. Do a quick look here at the markets. There's the Dow Jones up today after a massive sell-off yesterday, really not rebounding anything meaningful at all. I would say most of these are kind of just treading water. The Russell's been pushed back and forth. I mean, down at these levels of 197. We'll look at that. This is that small cap index, right? We've got a neutral negative on that, which means it's really in a bearish trend, but it just happens to be above this long-term trend, which is pointing higher. You can't deny it. But this range has really been established now. If I hit this 5-year chart, let's look back. For quite some time. I mean, we've been up at this 200 level down to this 160 level now, right? Since what's this? 2022, June of 2022. You can even argue even May of 2022, if not even further back to March of 2022, right? So when this downtrend established itself, it really just never got out of its own way. And it's definitely being dictated by the interest rate and bond markets. And let's look at bonds. TLT had a big sell-off yesterday. It's rebounding today, bringing it all back up about 0.6% or so. But the TLT really in a downward trend, tried to push higher with that market sentiment we saw about rates potentially being cut, which would obviously be great for bondholders. And now we're not so sure about that, right? So we're going to have to just, again, wait to see what's happening. Semiconductors still looking good. That upward trend is intact. The Qs also still in great shape, even though it had a big sell-off yesterday. It held that midline. That's a 21-day moving average here. So again, a lot of good things to look at, a lot of other things that aren't so good. But in general, we are intact, maybe still expecting a little bit more of a pullback, which could lead to some really great tactical buying opportunities for us as investors. All right, everybody. Again, I'm Pete Carmesino here at Chaikin Analytics. Follow me on Twitter at Pete Carmesino. Again, tune in here, leave me some feedback, leave me some comments. Love to hear what you're thinking. And if you see something that you wanted me to expand on next time, please let me know. All right, until then, we'll see you next week here on the Halftime Show. Bye-bye.